Hello, everyone, and welcome to the first Insight Associates podcast. My name is Garry Mumford. I'm the Managing Director at Insight Associates, and this time I'm joined by Simon Hammond, our Client Services Director.
Hi, Garry.
And also Mike Johnstone from TMD, a business that we've worked alongside and know very well, who's going to quiz us today about some of the things about cash flow management that he believes all businesses should be aware of.
Thanks, Garry. So, Simon, I thought we should perhaps start with the basics. The term cash flow is used a lot by accountants, but why should business owners care more about cash flow than they should about their profit and loss statement?
Cash and cash flow is really the lifeblood of a business. Profit is really an accounting concept created by accountants, but it isn't actually what keeps a business going. We've got an old saying in accountancy that profit is vanity and cash is sanity, because it's the cash that really pays for the bills, pays for your suppliers and your staff, and keeps the business running. So a business that is on paper profitable could still experience cash flow problems.
I've heard that before, Simon, but I think it'd be really good just to explain how that can be the case. That if you look at your profit and loss and you're making a lot of money, I think business people think, well, that's great. How can I not have any cash in the bank? Because it seems illogical.
It's really down to timing, Mike. If you've got a sale of, say, £50,000, but it takes you 90 days to collect that cash from your customer, in the meantime, you've got to pay for your payroll for 3 months, your suppliers for 3 months, and various other bills. If that gap between receiving your money and having to pay for your outgoings is too large, then even a profitable business would experience a cash problem during that period.
And typically, what does a firm then need to do in that situation?
Key really is having a decent, reliable cash flow forecast. So you're forecasting out far enough ahead to spot any problems. In advance of having experienced the problems, you can then plan to mitigate them, whether that be short-term lending, delaying supplier payments, or contacting your customers, maybe offering some discounts for early payments. So there's ways to manage your way through that period. But as I say, the key is to have foresight and be able to know when you've got a problem coming on the horizon.
Right. So the forecast should give you that indication that there's a problem. But what sort of things in your experience do clients miss? What are the blind spots, if you like, in terms of cash flow?
There's a number. Primarily not really understanding their collection terms and how their customers pay. Is all very well having payment due in 30 days on your invoice, but are your customers actually paying on 30 days, or are they squeezing it out to 45 days? So that can have a quite a large negative effect on your working capital cycle. Other issues are either being too detailed in terms of cash flow planning, cash forecasting, that makes it impossible to keep on top of and keep it as a working tool, or alternatively not being detailed enough, so not really having enough granular detail to be able to spot anything well in advance of any cash flow problems hitting.
And presumably that balance is quite hard, isn't it? Because you can't be completely accurate, but nonetheless you've still got to have some kind of forecast. So how do you achieve that?
Well, using the Insight Associates cash flow model is a good is a good tool. But seriously, we've developed a tool, a model that we've used over 20 plus years to really deal with that issue for our clients and client businesses. It's about knowing and really understanding the key levers in your cash flow, in your bank account, whether that's patterns of supplier payments or tax bills or whatever it may be. It's about really having a thorough grip on when those events, cash flow events, will be happening.
Does past performance actually prove something for the future? So you're talking there about clients and when they have previously paid. Does that mean you can look back and say, well, actually, historically, this client pays on 90 days, therefore we can assume they're going to pay 90 days in the future?
Yeah, as a starting point, that's definitely a way to start that cash flow forecast and base expectations on past experience. But also understanding that allows you to address those issues with your customers, for example, and have those conversations to ensure that they pay on terms rather than dragging things out. And that means that you will improve your cash cycle in the interim.
So presumably with a new client, because obviously it's easier for you with an existing client because you've got that history, but with a new client, presumably you've got to try and delve into that history and then potentially give them information they weren't even aware of?
Yeah, it's definitely more of a challenge initially with new clients. What we have to do is really get a quick and thorough understanding of client businesses, primarily what the liabilities and outgoings are, as outgoings tend to drive any cash flow modeling because you've got committed payments due, and then it's about modeling the sales receipt cycle around that. Part of what we do with new clients is effectively scenario planning for cash flow. So we build some contingencies into our models to say what will happen if your customers pay 15 days late, 20 days late. What happens if we push these supplier payments out by a week? That sort of thing, so that we've got levers that we can tweak and pull to come up with a working and accurate cash flow forecast.
And does that highlight things like where there's going to be a problem? For example, VAT payments is the classic. We say actually we need to have a chat with the VAT man and try and spread the cost of the VAT over a certain period of months. Presumably, it's better if you've got that knowledge in advance rather than waiting until the last minute. Is that right?
Absolutely, it's the same with lenders. If you're looking to approach lenders, be it a bank or other lenders that you want finance for your business, it's about providing credibility. If you've got a cash flow forecast that you can stand behind and say, "Yeah, I'm happy with that," and the reason that we are confident in this is because we have done our work, done our research, that all helps add credibility. And the same is true for the VAT man, for HMRC. They will want to know that you've done some preliminary work to determine that you definitely do need to arrange a time to pay arrangement, for example.
I think I know the answer to this question, Simon, but I assume that as an accountancy firm, if you contact a lender, you're more likely to get a favourable response than if a business owner contacts them.
Yes, I mean, as a business, we are ACCA regulated. We're full of qualified accountants here. That in and of itself generally gives some credence to any proposals or cash flow discussions that we have on behalf of clients with either lenders or HMRC. And just by dint of us being professionals and being experts in this particular area, it does tend to make the discussions a bit easier. Have you got anything you want to chip in there, Garry?
Yeah, I think the other thing that's probably quite important with that is that we often are talking to the same people again that we've got relationships with, that we know already, so we understand them as much as they understand us. And I think that adds a lot of credibility to both sides of the conversation. So we often find that we can get better results as a result of that.
Yeah, I think that makes sense. Over what sort of period do you recommend that you do the cash flow forecast?
13 weeks is really the perfect period. It's far enough out to be able to see any potential issues looming on the horizon, but it's not so far out that you're getting into the make-believe land and finger in the air sorts of guesswork. So when I say 13 weeks, it should really be a daily cash flow forecast during that 13-week period to really get into the granular detail of it.
Really? So you're looking at it every day?
Yeah, absolutely. That's definitely, wow. It's a key for us here. Not only is it making sure that what you expect to happen has happened, but also anything that you weren't expecting hasn't happened, and adjusting forecasts and your daily forecast based on what's happening in the business at the same time.
And presumably there are some things which you just can't forecast, you just don't know are going to happen. You suddenly get a client goes bust or whatever. You can't necessarily predict that. So there's some things out of your control, but at least you're giving the knowledge to the client, I guess.
Yeah, even in that circumstance, we're likely to get some warning in advance if we can see, for example, in your example, that customers' payments are getting later and later and later beyond terms. That's usually a good indicator that there might be some issues with that client, and on a whole other separate topic about what you do about that and how we deal with that. But in cash flow terms, what we would do in that situation is basically assume that cash isn't going to come in for the foreseeable future, and therefore work our cash flow model on the basis that cash isn't in the business. What problem does that give us? What can we do to manage that?
Yeah, and that scenario planning then obviously leads into all of that. It can take into account presumably lots of different potential disasters or positive things, I guess.
Exactly. Cash isn't necessarily, or cash flow management isn't necessarily about avoiding disasters. It's about also what can we do? What can we invest in here? What's affordable to help take our business forward? So it's definitely there's definitely two elements of it.
And is cash flow forecasting a different function, if you like, for a growing business than one that's been going around 100 years and is just stable? I mean, if you've got a startup that's growing really, really quickly, for example, how does that feed into the decision making?
Well, the fundamentals are the same. If we work in a cash flow model on a daily basis, we're going to be reviewing what's happening in that business on the creditors list, on the debtors list, various other bits and pieces on the balance sheet. So we understand what's happening in that business, and that informs our daily forecast tweaks. Now, that's the same whether it's a well-established business or a startup that's moving rapidly. We'd be undertaking the same process for each of them.
Right. Okay. And what's actually involved in the making sure that I'm maintaining an accurate cash flow forecast? You said obviously looking at it daily, but is it something that a business owner can do themselves, or why is it so much better for you guys to be doing it?
The reality is it's quite a bit of work to maintain an accurate, constantly developing cash flow model. It's the sort of thing that a business owner shouldn't really be spending their time on. They've got better things to do with their time rather than managing cash flow. It's one of those jobs that there needs to be an element of expertise that comes with it. So someone needs to understand what they're doing. They need to understand working capital cycles and the needs of the business. So although it can be done on a very simple basis, that's not really going to provide the value that you need from a cash flow model. So I would always recommend having someone or having a business look at it professionally to make sure it's maintained properly.
So Simon, you say that you keep an eye on cash flow forecasts for your clients on a daily basis, but do you provide them with that information every day?
We tend not to update every day because that tends to become noise then in the background for the client business. What we do is we provide weekly reports, and as a rule we tend to forecast, even though we're using a daily cash flow model, we tend to provide weekly and monthly forecasts for the foreseeable future, 13 weeks and beyond. So we provide that, but the work that goes on behind that, the client is confident that there's a lot of intricate detail that goes into producing the output. So we effectively distill all the many different elements of a cash flow into something that's usable and valuable for a client business owner.
And just so I guess you're saying that you would provide the reports, but obviously pick up the phone and flag something if it's if it's an impending disaster that they need to be aware of.
Yeah, I'm happy to say that we don't tend to see pending disasters because, as I say, we know about things.
Clearly, Simon only.
Yeah, yeah, maybe. What we are good at is maintaining banking relationships as well. That I know that many clients don't have access to, as the banks change their client servicing models to be call centres and not named managers. So we've maintained a really good raft of contacts in various different banks, so that we're able to help when the situation arises, help clients with any difficulties in terms of day-to-day banking operations by virtue of having those contacts still.
Which is something obviously that the business owner wouldn't be able to do.
Yeah.
That's great, Simon. Thanks very much. I've learned a lot. Gary, any final thoughts from you?
Yes, it's been really interesting, Mike, hasn't it? Thank you. And thank you to Simon for all your comments. I think the big takeaway for me for this was the issue about making sure that your cash flow is not only realistic, but perhaps erring on the pessimistic side. To my mind, a good cash flow forecast, you should always better it, not do worse than it, because if you do worse, the chances are you'll run out of money. I'm sure you agree with that, Simon.
Yeah, absolutely. It's always better to have more money in your bank than you expected than the other way around.
Yeah, it's always the cash that's going to kill you, not anything else. So I hope everybody's found this really interesting today and very useful to them. We will look forward to welcoming you to a future podcast in the series. In the meanwhile, if you want to learn a little bit more about Insight Associates and what we do, why not sign up to our Insight blog, which is available at insightblog.co.uk. Thank you very much for listening.